How are you, Vic? Waiting to hear you. Unmute.
Okay. Can
There
you
you
hear
are.
me?
Got you, Vic.
Okay,
All
cool.
right, so I'm going to be sharing my screen here, and it really is a great pleasure to speak to someone I followed for a long time, and many people are excited to have you here. And I appreciate you taking time to speak to our community, Vic. And uh, it's really an honor to talk to you. You've been an icon, and especially in the commodity complex. Used to watch you on, gosh, I think even back to the old. Do you remember FNN, Vic,
Yeah,
the Financial News Network before CNBC?
correct.
Okay,
I think that, yes, before CNBC.
yeah. So Vic, I've read the bio, and I like to do this. I know you've had a long and storied career. In fact, one of my heroes gives you such a great testimonial. I think it's Paul Tudor Jones here, and he talks about, that you're. Here's Paul's quote about you. Why don't you
Mhm.
tell us what you were doing before your first gig in the business and how it happened for you?
All right. Well, started in 1966, January 2nd, actually, at Pershing and Company
Okay.
as a very high position called a quote boy. And
Is that like a runner?
we used to, Pershing, as you know, is a broker's broker. And
Right,
in those days, orders came in over the telecom.
right.
So we had a circle where you would take an order that was telecommed in from, say, Kansas, and you'd run over to whatever a space there was that would have that particular stock, say IBM. You would give it to the clerk. He would call it down, and Pershing was very fast. They could execute an order in minutes, and then we send it back. So it wasn't it was a great starting position. I met a guy named Milton Leeds. Most people never heard of him, but he was a day trader for Pershing, and
Okay,
it really led to me wanting to be a trader.
okay. Yeah, I mean, how fortunate in the days where you had big communities and people weren't isolated from COVID, and there used to be trading floors. Were you ever a member of a major exchange? You ever
Oh yeah,
try that? Yeah, was it Comex?
yes, virtually all of them except the New York Stock Exchange.
Okay. So, I mean, you had that experience too. I mean, where you could rub shoulders with some of the best traders in the world. Although a lot of floor traders, Vic, and you definitely made the transition, but there are a lot of floor traders that never learned how to be right in the market. All they had to do was trade the paper, right?
Right.
And a lot of guys couldn't make that transition, but you were always interested in the mechanics and what's behind the market. And it seems like you always had a bias by the things that you wrote and shared what you were seeing ahead. So congratulations on reinventing yourself after the floor days. So anyway, why don't we get to what's happening today now? We've had a big weak in the dollar, possible dollar turn, and the S&P's had that big break in January. Nasdaq was even deeper. What's your take on what's happening here in the markets and the change of the regimes by central banks around the world? Are they
Okay. Well,
making policy errors here, Vic?
they're always making policy as the question is how much. The concept of being late on thinking inflation would be as high as it is and as sustained as it is, they're now using moral suasion to talk the market down, the inflation expectations down, and that's really the policy. The policy is not raising rates, according to Jamie Dimon, 7 times. That is a propaganda machine there with all these banks coming in, one outbidding the other with how many rate increases they're going to be, because they want to talk. They want to talk this inflation rate down. In my view, tops 2 rate increases, and that's for show. That'll be a quarter each for show, if that. And we have to see what that's going to be when you come to April, because the economy is slowing down. Now, this
Right.
jobs report today is 467,000. I don't have the number in front of me, but it basically, because I'm talking to you, so I don't see it on my machine. But
Can you really trust these numbers anymore anyway, Vic?
no,
I mean, revisions and everything. I know markets react to them for the first half an hour, but I think you're a guy. Price action's everything, and people who buy headlines today sell newspapers tomorrow.
right, right. Well, if you go back 10 years in January, the non-seasonally adjusted numbers, which you don't see unless you go and look on the BLS website, is 2.7 million jobs lost.
Yeah.
That's the average of the last 10 years. There never is a positive number because everybody's letting go of the Christmas season hirings. Yeah, 467,000. So the key here is it can be any number you want because it's seasonally adjusted. They just pick a number to make it average out for the year so that it all adds up during the year. So jobs increase generally, except if you're in a recession, after January, but it just is to blend so that it's a smooth number. This number has no meaning whatsoever. I mean, that jobs number has zero meaning. So you really have to look at the other parts of the economy to get a feel of what's going to happen with Fed rate increases, and that is if the economy is slowing down, which I see things like sentiment, the ISM numbers, all these various economic releases. There's no way you're going to get more than 2 rate increases, if that.
And even so, Vic, what do you think? I bring up that the Fed could raise rates 50 times, and I'm not going on a diet, and grains to care more about weather than they care about rates. Looking at oil here, I know you're a commodity guy, Vic, and this has been nonstop since we had that negative print during COVID. How's the Fed going to control inflation if they can't get a handle on oil? And we all know that SPR release was just a token gesture, like trying to jawbone the market down. You think we're going to see 120 oil here this year?
Absolutely, before the end of March.
Wow. Are you looking for an invasion, or will it be avoided?
No, you're talking about Russia, right?
Yeah.
Yeah, no.
Okay.
No, that's propaganda to wag the dog story to get Biden's horrible numbers to be distracting.
Okay. All right. So unless we get a break in crude into the summer, it would be looking pretty bad for the midterms here. As far as the S&Ps, do you think that we put in a long-term top? Are you in like Jeremy Grantham's camp that this is the bubble of all times? I think he calls it a 3 sigma event that he's looking for. But I mean, he's been saying that for a year or so now.
Well, yes, and everybody that looks at valuations, he's an investor type. I respect him, but I am not in that camp at all because there's so many people that are in that camp, that are in the crash camp, and I am too. But I am saying you're not going to see it coming. It's going to be a surprise event. It's not going to be something where the Fed and the banks are telling you they're going to raise rates 7 times.
Yeah. So it'll be something we're out of left field, and it won't be Fed related. It could be, how about the vaccine crash where, there's a possible variant that evades vaccines, some type of event like that, or China.
China is more likely after the Olympics where they make a move on Taiwan, and that it's going to be.
Do you think that's going to happen after the Olympics?
I would say 60-40, yes.
Okay. All right. So while we're distracted and looking at Russia, and then we see the beautiful opening ceremony, and I watched some of the prelims yesterday, after February 20th. I know a lot of psycho guys are looking at March as being a very critical month for a lot of things. Fed meeting there in March as well. So that would be something that's out of the purvey of the Fed, some kind of geopolitical event like that. And also, isn't China with their zero tolerance when it comes to oil? They are what, the biggest consumer or second biggest consumer of oil?
They're the biggest consumer of everything.
Okay. Yeah. So yeah. So if after the Olympics, despite all of their efforts, COVID's going to spread there, and they have a zero tolerance policy that they reinstate after the Olympics, they could really shut down the whole country. And wouldn't they have an impact on the oil and other commodity markets?
Oh, absolutely. But I don't see them doing that. I mean, they care more about they don't care about climate change either. They care more about feeding the masses, which keeps their political power. Now, I do understand the Omicron problem, but it's not a death killing. It's not Ebola. You know what I mean? So I think they play it a little differently. And I think a surprising event, and this is my own speculation, but it's since you're a currency shop, would be for OPEC, meaning Saudi Arabia, which is not.
I know where you're going.
It's not very close to the current administration, to say the least. See what I
the end of the petrodollar.
Right, and using there's no other reserve currency. It'll be a basket, and it'll probably include some gold.
Okay, so I wanted to get to gold and the dollar. A lot of people, when you look at the dollar, Vic, you can interpret this, especially with the great week we had in the dollar, as this whole thing that we had during 2021 as just being a bear market rally back to here, and that the dollar decline could begin in earnest again. Do you think the Fed welcomes a weaker dollar? Does that attract foreign buyers into treasuries and makes it easier if they do go ahead and tighten, and gives them more of a window to do it?
I think that their goal with the dollar is stability. That's what it has been. That's their goal now. I don't think
not bad. They've done a pretty good job from 2014 to now. I mean, it's been in a pretty wide range, but it is, that is a huge range.
Yes, but it's basically stable. I mean, for me, currencies are rather stable trading vehicles, but neither here nor there. I'm just guessing, and I don't have a strong opinion on this.
Do you have that? You know what, Vic? That is that's a pearl, because people have a hard time saying, I don't know. You ever notice that on Twitter? I don't know, and I was wrong. Which the great, all the greats are wrong. Even, Paul Tudor Jones has drawdowns. Sure. Everyone has drawdowns. So, when I was a young guy, and I, probably, we're in the same generation, I used to feel dumb if I didn't know. Now it's wisdom to admit you don't know instead of trying to force an opinion. Do you have an opinion on gold?
Yes, I have a strong opinion on gold. And let me just say, I have been an investor in gold since '94.
Yeah.
And have, a great deal of my assets tied to gold in one form or another.
Miners.
So that's all ways and shapes.
Yeah.
But let me just say that here, I'm a student, so in this case, I'm going to say some things that are not in the mainstream at all. People just don't understand. I'm going to give you some concrete evidence to support my case. But you see, gold is a relative inflation hedge to other things. The best inflation hedge are stocks. Why? Because they pay a dividend and because they can raise prices. As you witnessed last year, the great earnings they had, raising prices. So most institutional investors and most investors will go with stocks as long as they're making money. That's the key concept right there. Now, what should happen and why gold, which by the way is highly negatively correlated to stocks, as I'm sure all your listeners know. So the key is that gold will go up when stocks are going up with one contingent, when rates are rising. So gold is going to go up when the Fed actually does increase rates a quarter or so. Now, if any of you want to doubt this logic, go to 1977, pull up a Bloomberg chart on stocks, which went down for 11 months in a row
I
without a
remember
5,
it.
without a 5% rally.
Yeah.
And gold went straight up as soon as stocks came down. And there was inflation accelerating. As a matter of fact, the Fed funds rate went from 5.5 to 19 in
Yeah, that
that.
was Volcker.
So
Yeah.
I'm even before Volcker, he came in November of '79, but before that, Fed funds were moving up steadily. That didn't stop inflation. Why? Because the Fed was printing more money. Let's say you're a manufacturer and you're making 20% a year, and the Fed is pouring money into the system, and they raise rates a quarter. Do you care? Are you
No.
going to stop production? You only stop production when the money supply is curbed and you can't borrow money. Then your inventory is screwed. Then you got to liquidate.
Is
So
there any difference, though, Vic, between the 70s and now, just based upon the size and magnitude of debt structures and participation in financial markets? I know that cycles don't repeat, they rhyme, and this reminds me a lot of the 70s. But, could it be that that was like a 10-story building, and now we're talking about one of the tallest buildings, market structures ever built?
yeah, but the key here is that, and Milton Friedman proves this for hundreds of years, it's always the money supply versus the goods and services being produced that creates inflation. So it's the
Okay.
money supply expansion. Yes, demand will be curbed when you raise rates to a degree, but the proportionality is to what degree? If you're pouring, I mean, M2 was increasing from January of 2019 to date at a 15% plus rate, and M1 was increasing at 77%. You see, so you're going to get inflation. If you don't curb the money supply, you're going to get inflation, period. There's no way around that. And, if you give me your email, I'll send you, this goes back to the late 70s when Milton
Okay.
Friedman made a speech. He proves this with about 7 different countries, and he shows the correlation between inflation and money supply is literally 99, and it basically is in any country at any time. So it's 2 and 2. You print
Okay.
more money and you don't produce more goods, prices rise. It's that simple.
Okay. Well, while it was being announced that you were going to be here and I was going to have a chance to talk to you, I got some action on Twitter. And one of the questions are, people want me to ask you about your end game insight and forecasts, and how you think this whole thing is going to play out over the next couple of years. Can you give us
Yeah.
the cliff notes of that in about 8 minutes, 10 minutes?
Yeah, sure. It's pretty easy because I thought about this. First of all, you got Stephanie Kelton, MMT, Modern Monetary Theory. She's
Right.
all over the Democratic platform when they were writing their policies. And you can see that. That's why they want to spend trillions. And, they basically, she's got them convinced. She's given a politician an answer to how he can spend more money and get away with it from from her opinion. But the point is, you're going to get this crash that Jeremy talked about, and it's going to come when it's least expected. But the end game, the how we get out of 30 trillion in debt, and by the way, you're not counting off balance sheet debt. Last I looked, it was over 10 trillion. That's
Okay.
off, but they don't show that. That's the post office debt and other weird debt, like even student loans. The key here is people don't like chronic pain. They
Yeah.
they can withstand short-term pain, and then if it eases, they get happier. Now, with that thesis, now again, everything is relative. It's how long is short-term pain. But if you want to get rid of the debt, which is really what everybody talks about, but has no meaning because nobody acts on it, is with hyperinflation. So
Okay.
if, for example, you hyperinflate, the definition is 50% in a month. That's what the definition is. That's an academic definition by Phil Kagan.
Okay.
And you basically, in 4 months, a 50% CPI increase, the 30 trillion would go down by 94%.
Wow.
So then you start over. So it's a 4-month
Okay.
deal. So you can't go through a depression. That was, well, some say 4 years. It went longer into World War II. But the point is, 4 months. Now, it's a horrible scenario. Believe me, I've studied hyperinflations. It's not a good thing. Marie Antoinette learned the hard way.
Yeah.
That was the first hyperinflation.
So did the Germans. So did the Germans. So, I was thinking that maybe like last round, it was the Germans had hyperinflation and we had deflation. And perhaps this time we have the hyperinflation and they deflate.
Well, that's the way it's headed in my book. Now,
so a weak dollar is a part of your scenario, and that would help fuel the inflation. Look, we have inflation while the dollar has been steady for a year, right, Vic? So isn't a weak dollar only going to add gasoline to the fire?
Well, that's where you get the hyperinflation. It's a run from the money.
Okay.
So effectively, the dollar declining in a material way is what's going to cause hyperinflation.
Okay. So, we're close, may have started this week. A lot of people are saying, we made new highs for move. We've shaken out a lot of Euro bulls last week on the Fed. Dollar made new recovery highs, Euro down towards that 111 level. So I guess what you would advise people to do is diversify in their fiat and own hard assets and stocks on sharp declines. Are they going to close the market down during this? What's going to happen to, say, equities? Go ahead.
I'll say it this way. The worst scenario, if you ask 10 economists, would be a depression. Okay, so you say, what's the worst scenario economically you can have? They say depression. In my world, the worst scenario you could have is high inflation and recession depression. That would be the worst. Because the Fed is in a box, as everybody relates to it. If they do raise rates, because of recession, the Democrats will lose power for 20 years. So they're not going to. They don't want to cause a recession. They just want to talk the market down to stop the inflation expectations. But they don't want a recession. But if you do 4 rate increases, you're going to drive the market down, and you're going to cause a recession.
Well, I know a lot of guys that say they're going to tighten. They are going to go ahead, and then when everything comes apart, it used to be in our day, wasn't it 2 steps and a stumble? Remember that? Okay, yes. So the stumble would be them coming in with bazookas that made the COVID response look like amateur hour. And that's when we get the hyperinflation, is after we have some type of bust in the market and they come out with bazookas that are much bigger.
Correct. And that also would cause, as you talk of raising rates up to 7 times in a year is what Chase said. I mean, you get people buying the dollar to basically get a higher yield. And they basically get the stability of the dollar as long as that occurs. Now, if there's bad economic news, I mean, this was relatively good because it was 150,000 projected payroll increase.
Yeah.
And there was even talk of 400,000 minus. Like I said, it can be any
like
number
the ADP this week.
That's right. And it
Yeah.
could be any number because they seasonally adjust these numbers. So next month they'll reduce it a little bit to smooth the number to what they think employment will be for the year. And they average it out monthly and they just adjust the numbers. But the key is that if you see bad economic news, that's when you're going to see the dollar weaken. And good news is bad news in this case for if you're short the dollar. But the key is it's gonna go the other way because the economy is slowing and there's no more build back better in the coming up in the stream of spending. You're gonna slow down and basically the Fed is never gonna.
Well, here's my here's my back up the truck level in gold 1730 to 20ish if we get there in the next month, and silver maybe around 19. So I know you're a metalhead, and I'm not talking Metallica. Do you think the gold silver ratio, Vic, is gonna, remember when the mean used to be about 40, and we peaked up above 100? Do you think silver will outperform during this that period that you're talking about over gold?
Yes, because if more people will run to silver.
Poor man's gold.
It's poor man. It's like the stock split in Google. You know what I mean? They lower it because people buy lower prices. They get round numbers and they like that.
They could have a bigger stack than just having 10 Krugerrands somewhere, Vic, so I want to ask you something about your website. Do you have any kind of business model? Why are you, out there in the public? Are you looking to gather subscriptions or, the purpose of your website?
Generally, we do institutional business. And what I do is I build trading algorithms.
That's right. I saw that.
These various commodity indices, which S&P branded them. Now that we took them back, so we have them back. But I build these models depending on the needs of the customer. It's generally institutional. It's generally with mutual funds. We had one listed with Wisdom Tree, the DTI, which basic diversified trends indicator. What happens is with all of these deals I do with people that once they pay the fees and we have license fees for this stuff, they try to do it themselves. They usually blow themselves up. We have this with Rolex. We have Wisdom Trees. What they have today that trades is nothing like what they used to have, and it's a poor performer if you look at the data. But the point is I build these things for certain purposes and I custom it, and that's what we still do today.
Well, thanks for addressing the retail community today, Vic. I really glad that our paths finally crossed after following you for many years. What's your favorite book, Vic? You wrote them all. What's your favorite book and which was the best seller?
Well,
they're all your favorite.
Going back to so many years when I first started to read books, Dow Theory was one of my biggest moneymakers, believe it or not, by Robert Ray.
Okay.
And I read many of Gartley's books on technical analysis. These were excellent books. Of course, the stock speculator or reminiscence of a stock speculator. There are these classics. I don't have anything today that I could recommend, but that's me because I haven't been, I've been reading the new stuff. I've read maybe 3,000 books, and I'm very, very happy with what I've learned in the old books. Markets evolve and they change and rules change. And for example, this is not something well known, but in 2011, when the Fed started to pay interest on reserves, if you go back to that period, now that didn't strike me, to be fair. I didn't get that originally, but hats off to the PhD that came up with that, because what they basically did was pay the banks not to loan money. So you got very low relative rates of inflation. Money supply was under 6. The M2 grew at under 6. You got inflation at as low as 164 on a 10-year basis, ending 17. You'd have to go back to 1955 to find a lower 10-year rate. And it's all because the banks took the money from the Fed. look, let's say you're borrowing at Fed funds rate when it was 2%. What are you going to loan to a prime customer? You're going to loan 3. Well, for that 1%, you'd rather take the 2.25 and bank at 100% and not have any reserves. There's no reserves when you do that. So I'm only saying that basically that rule change in 211, also what's called hold to maturity accounts. What the banks do, they print money and buy from the government as well, but they didn't want the mark to market. So in 214, they made them change the rules, and basically they have this thing called the hold to maturity account. No capital hits, no mark to market. They print the money, and there's no Basel III capital hits either. There's no reserves and no capital hits. I mean, it's an arbitrage. They arbitrage the interest.
So what's been happening in the Fed funds market with all the drains that were happening, and the Fed came in last fall and really started.
That's a great question. And they got up to 2 trillion in the end of the year, or 19 odd. And that to me was when the Fed wanted to stop inflation once it got to be a political event in the latter part of the year last year. What they did was reverse repos are a drain, right?
That's right. So they used to call them match sales.
Right. Okay. Yeah, exactly.
Yeah.
So you basically are holding that. So what the Fed is doing now is with their right hand, they're talking about their balance sheet and raising rates. But on the other hand, what you'll see is anything they do to tighten, they will reduce the amount of reverse repos. So it's offsetting. So it's a trick. I mean, they're just fooling most of the people,
All right. Well, Jekyll Island, a lot of things happened. I wouldn't go on a vacation there to Jekyll Island, which is where it was formed. So, they're taking profits, Vic. They're a private institution. They're booking some profits from their longs for the last 10 years, right? So really, isn't that possible? I mean, they want to make money too. The Fed wants to make money. So, and all the Fed governors, can you ever believe, and I want to wrap it up with this, would you have ever believed that Fed governors were trading before Fed meetings and having positions? And I know it goes all the way through the Congress too. The Fed then talking about transitory inflation, and now they're tightening. Are we moving towards an era where the Fed is, about to lose control and credibility completely?
Absolutely. And I mean, the whole
they're going to dissolve it in the new era?
That institution is so ingrained. I don't know about that. I haven't thought about that.
All right.
But all I say is everything is being corrupted. And there's certainly, I mean, just to make the case in point, when Powell was asked by one of the reporters, I think it was Bloomberg, if he had the dates of the trades, and he said no. Listen, I'm a compliance officer for my firm. If I make one trade ahead of my indexes, I mean,
we'd be in jail. We'd be in jail for this.
My compliance officer and my legal department come down on me like, give me a break. He doesn't know the dates. Of course he knows the dates. He just doesn't want to embarrass himself more than he's already embarrassed.
Yeah. Well, I was proud to have you on today, Vic. I really appreciate your time today, and hope that we could do it again. And everyone should follow you at Vic Sperandeo on Twitter, and check out Vic's website. I see some great content on here, victorsperandeo.com. And, you survived an interview with me, but I knew you were tough. And now you're my trading warrior brother.
Well, anytime they'll just reach out to me. You've got my cell number, I think. If not, just let me know and I'll send it to you. And I'm always happy to comment if I can. My strong point, because currencies are relatively stable, not in your world, but in my world. I don't have strong opinions either way on that, but occasionally I do. And I know what's going to happen in the end, but you can call me anytime.
Thank you so much, Vic. Really appreciate you being here. And thank you, everyone. Hope you enjoyed, Vic. Getting some comments. A lot of people will watch this video. And I just want to end the week with don't just count your pips, count your blessings. Thank you, Vic, and look forward to talking to you down the line.
Thank you. Same here. And thank you for the interview.
All right. So that's a wrap, everyone. You could join the team in 7 minutes for the morning edge. Have a great weekend. Use the time the markets are closed, except for crypto, to come up with your plan. And I'll see everyone Monday. Adios and good hunting. Thank you, Victor Sperandeo.
Pleasure. Thank you.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.